Lockheed Martin. You look at this company, and on the surface, it looks like an absolute fortress. I mean, an impenetrable wall of government contracts, steady shareholder returns. It's the picture of stability. But then you dig into the latest full-year earnings report, and you start to see these little lines, stress fractures. Suddenly, it's a story of record-breaking, unbelievable demand fighting against a story of severe, costly operational failures. And honestly, this is exactly the kind of company we live to analyze.
Welcome to Iron Financial. Look, we're not here to just read you the happy headlines from a press release. That's not what we do. We are here to help you forge a stronger portfolio. And we do that by stress testing the numbers, by cutting right through all that corporate noise, and by analyzing the true structural integrity of a company. So today, we're putting Lockheed Martin under the microscope. We're going to figure out if this thing is a solid as rock investment or if it's an accident just waiting to happen. All right, let's get into this.
Okay, so let's start with the bull case. Let's start with the good news. $194 billion. I want you to just look at that number. This is the figure that Lockheed's management wants burned into your brain. It's their record-breaking backlog at the end of fiscal year 2025. This right here is the narrative. It's the story of an unassailable fortress, a deep moat just filled with guaranteed future revenue that stretches for years and years. This is their shield. This is what they hold up against any market uncertainty.
Okay, hold on a second. A massive backlog? I get it. It's an impressive number. I'll give you that. And yeah, the CEO is certainly selling the story hard. Unprecedented demand. You hear that phrase a lot. But my question is this number just a headline? Is it a vanity metric? Or is this high-quality, high-margin work? Or is it just a gigantic pile of future obligations that could be hiding some really serious problems down the line? A big number doesn't automatically mean a strong company. Not by a long shot. We have to see if any of this actually translates to the bottom line.
Exactly, that's the real question. So let's build their case first. Let's be fair. We're going to look at the big picture numbers they're presenting to Wall Street. The top-line metrics that paint this exact picture of a fortress of orders. This is the story the bulls are telling themselves, and this is the story they are selling to the market.
Now, what's really interesting when you look at this is the sheer strength across the board. Let's actually take these one by one so they can really sink in. First up, sales. They're up a very healthy 6%, landing at $75 billion. Now, for a company of this massive scale, that is not trivial growth. Then you've got the backlog, which, as we just said, hit a new all-time record of $194 billion. Next, just look at the cash they're cranking out, an incredible $6.9 billion in free cash flow. And get this, that's after making a pretty significant pension contribution. And finally, they're not just sitting on that cash, they're giving it back to shareholders, buying back $3 billion worth of stock. I mean, on paper, this looks like a well-oiled machine just firing on all cylinders.
Yeah, I see it. 71 billion up to 75 billion. That's solid, consistent growth. No one can argue with that part of it. It shows the demand is absolutely real and that their customers are writing bigger and bigger checks. But this is where my skepticism really kicks in. There's an old saying, right? Sales are vanity, profit is sanity, and cash is reality. They've shown us the vanity and the reality. But what about the sanity? Is this growth actually profitable, or are they just selling more and more just to stand still?
And that right there is the billion-dollar question, isn't it? Because for all the strength you see in these headline figures, for all the talk of these high fortress walls, the foundation underneath it all is showing signs of some serious stress. The top-line numbers, they just don't tell the whole story. To really truly understand what's happening at Lockheed, we have to stop looking at the press release and start digging into the fine print of the financial statements. And this is where the real work begins.
Right. This is what Iron Financial is all about. This is our bread and butter. Anybody can read a headline. We're here to analyze the footnotes, the stuff people skip over. We've seen the impressive exterior of the fortress, now we need to get down on the dirt and inspect that foundation for those cracks. Because if the core profitability is actually eroding, that massive backlog, it could suddenly become a massive liability, not an asset.
Okay, before we show you the numbers, it's absolutely critical that you understand this term, a reach-forward loss. This is not some minor accounting adjustment. This isn't just moving numbers around. This is management being forced by accounting rules to admit something catastrophic has happened. It means they have a long-term contract that is so far off the rails because of cost overruns, schedule delays, or performance issues that they know, right now, today, it is going to lose money over its entire life. So what they have to do is reach forward in time, grab all of that future anticipated loss, and pull it all the way back into the current quarter as one single massive charge. It is a blaring, bright red flag for massive execution problems.
And here they are, over $1.6 billion in just these specific charges for 2025 alone. Just look at these numbers. $950 million on a single classified program in their main aeronautics division. Another $570 million on a helicopter program. These aren't just cracks in the foundation, these are gaping holes being blown in the company's profitability. This is not just a tough quarter. This signals deep systemic issues with our ability to manage their biggest and most complex projects. That fortress wall, well, it suddenly looks a whole lot less secure, doesn't it?
So the crucial point now is to see how these losses are impacting the very core of the business. Let's start with the crown jewel. Let's talk about the aeronautics division. This is the home of the F-35 fighter jet. It is the largest and, by far, the most important segment of Lockheed Martin. Let me be blunt. If this division is unhealthy, the entire company is unhealthy.
And just like the company as a whole, the top line for aeronautics looks great. Sales grew a healthy 6%, from about $28.6 billion to over $30 billion. And this growth is being driven by higher volumes on the F-35 program, so demand is clearly not the issue here. They are building and delivering more of their flagship product. Everything looks good.
But this slide right here brilliantly illustrates the entire problem. This is the paradox at the heart of the company right now. Sales are up 6%, but their operating profit, it collapsed by 17%. Let that sink in. They sold almost $2 billion more in planes and services, and somehow they made $400 million less in profit. How is that even possible? Well, this is the direct impact of that $950 million classified program loss we just saw. It's completely wiping out all the benefits of that top-line growth and then some. This is a severe, undeniable margin problem right in their most important business segment.
And the problem isn't isolated just to aeronautics. Let's move on to the Rotary and Mission Systems division, and you can see how this pattern builds. This is where they make things like the Black Hawk helicopters and other complex mission systems. Here, believe it or not, the story is even worse. Sales were completely flat year over year. I mean, zero growth. They didn't grow at all. But now, look at the operating profit line. It fell right off a cliff, down a staggering 31%. As a result, you can see their operating margin was just crushed, falling from over 11% all the way down to 7.6%. This is exactly where those two helicopter program losses, totaling over $665 million, did their damage. Flat sales and collapsing profits. I mean, that is a truly toxic combination for any business.
All right, but then you see a number like this, and it almost looks like a typo, doesn't it? Missiles and Fire Control, operating profit up 382%. That's incredible. But wait, I'm guessing there's a story here too. This isn't some amazing organic growth story, is it? This feels like an accounting story. So explain what's really happening here.
You've got it. You've nailed it. This is a perfect example of why you can't just look at a percentage change and call it a day. The 382% growth looks massive, but it's only because the 2024 comparison number was so unbelievably terrible. Back in 2024, this division also took a huge reach-forward loss, to the tune of $1.3 billion, which basically pushed its operating profit down to almost nothing. So what you're seeing in 2025 is really just a return to normal profitability after an absolutely abysmal prior year. Now, it's a good recovery, don't get me wrong, and sales growth of 14% is strong, but that 382% headline, it's incredibly misleading. It's just lapping a disaster.
Finally, we get to the space division. And this, right here, this is what a healthy, stable business segment is supposed to look like. Sales are up a solid 4%, operating profit is up 10%, which means their margins are actually expanding. Look, it's not setting the world on fire, but it's steady, it's predictable, and it's profitable growth. This is the bedrock of the company right now. It's providing some much-needed stability while other major parts of the company are just in total turmoil.
So let's just step back and put it all together. Two of their four main divisions, aeronautics and rotary systems, which, by the way, account for the huge majority of the company's sales, they both have deep, undeniable profitability issues. One division, missiles, is just recovering from its own prior disaster, and only one division, space, looks truly healthy. So the focus has to shift. With this much internal turmoil, what are the external risks? What does the overall financial health of the company look like when you start to factor in these massive execution problems?
Okay, so let's bring in some third-party analysis to get a broader view of the situation. First, the balance sheet isn't exactly pristine. A debt-to-equity ratio of 3.59 is high. It indicates a significant reliance on leverage to run the business. What's more concerning to me is the historical trend. According to Guru Focus, the operating margin has been in a 5-year average annual decline of 5.7%. So this tells us that the margin compression we're seeing this year, it isn't a new problem, it's an accelerating pre-existing trend. The market has definitely taken notice of these execution stumbles. And then there's this last point, the Benish M-score. Now, this is a mathematical model that uses 8 different financial ratios to check for red flags of potential earnings manipulation. Think of it like a smoke detector, not necessarily a fire. A score of negative 1.08 is in a gray area that suggests investors should be cautious and look a lot closer. So, to sum it up, you've got high debt, a history of declining margins, massive public execution failures, and an accounting model that's waving a yellow flag in the background.
So this brings us to the verdict. We've laid out the bull case of the impenetrable fortress, and we've exposed the bear case of the cracked foundation. What you're left with is a company performing a very, very difficult balancing act. It's a story of incredible, undeniable strengths being weighed against very significant and very real weaknesses.
This really sums up the entire conflict, doesn't it? On the left, you have that solid foundation of strength, that immense $194 billion backlog, solid 6% sales growth, and a powerful cash flow machine that generated nearly $7 billion last year. But on the right, you have these deep, visible cracks in the armor. Over $1.6 billion in program write-downs, severe margin compression in their biggest divisions, and those underlying risks of high debt and a demonstrated inability to execute on key contracts.
Exactly. So the past is what it is. It's done. The real question for any investor at this point is, what happens now? What is management telling us they're going to do to fix this foundation? The demand is there, right? We've established that. But can they actually execute? What are they promising everyone for 2026?
And here is their promise. This is management's official guidance for 2026. They're projecting continued sales growth up into the $77 to $80 billion range. They expect to maintain very strong free cash flow, somewhere between $6.5 and $6.8 billion. But the crucial line is that last one. They are guiding for approximately 25% year-over-year growth in segment operating profit. This is a direct public promise to investors that they are going to fix the profitability problem. They are essentially telling the market that the massive losses of 2025 were a one-time clearing event and that 2026 will be the year of the big recovery.
And that's what it all comes down to, isn't it? That's the tightrope they have to walk now. Can they actually deliver on that 25% profit growth promise? Can they stop the bleeding on these mismanaged programs and finally convert that historic fortress of orders into actual, tangible, profitable results? The answer to that single question will determine whether this stock is a massive opportunity, buying after a clearing event, or if it's a value trap, where the operational problems are much more deeply rooted than management is letting on.
So the final verdict from our end is this. The investment case for Lockheed Martin is no longer about demand. The world is buying what they are selling. That debate is over. The entire thesis now rests on one word: execution. It is no longer about the strength of the fortress anymore. It's all about the skill of the builders. Investing in this company today is a pure bet that management can finally get control of its costs, that it can clean up its operations, and that it can deliver on its promise to turn that mountain of revenue into a truly profitable future. The foundation has been tested, and the repairs must now begin.